So here we're going to look at what's happening with crude and product exports. So one of the things that we were expecting was a bit of a bounce, obviously not, depending on where it's going, how it's moving. We still expect there to be a bit of an overhang when you look at where some of the flows are. It'll be interesting to see how some of the blending components get moved into the system. Will they go out as, it'll go out as gasoline, but essentially regions can use it as petchem feedstock. So we'll see how that progresses as we go through the remainder of this period. But then when you look at just where gasoline exports bounced 295,000 barrels a day, still well below the 5-year average. Disti increased 200,000 barrels a day. That declined by, that's still well below the average. We expect those to still, gasoline will continue to kind of ramp up with seasonal norms, but still be below average. And then propane had a bounce of 120,000 barrels a day, well above the 5-year average. That's where we're going to continue to see strength. Now, remember, we thought that the export of 400,000, the export of 2.114 million was low. We still think that 2.5 million barrels a day is low. We think it's much closer to about 2.7 right now. And when you look at the adjustment factor is pretty wide this week. And it's one of the things where we think imports are too low, exports are too low as well. So you're starting to see some of this kind of movement as to that, and that'll clear itself up in next week for the most part. So this is where we're seeing some of this competition. We do have, remember, we have a fairly steady flow. So 17 tankers carrying about 11.4 million barrels of oil have arrived in Europe so far this month. After loading in the U.S., another 33 tankers are expected. Total volume for October should be about 1.09 million barrels a day, which is the highest since June, compared to with a revised 920,000 barrels a day in September. And when you look at where things are, remember, one of the things that we've been saying this whole time is that you get a very steady move in general when you're looking at some of the adjustments overall. And the key piece is when you're looking at some of those adjustments, there's a very steady bid of about 1.8 million barrels a day of crude moving from the U.S. So that's not really crazy. So when you look at where the refining margin is, and I show this Singapore refining margin specifically because when you look at it, not including cost, we're at these highs. But when you look at it including cost, you can see that things are not as good as they look. They're still better than they were and getting better, but you can see that we're coming from this very low point due to natural gas pricing, because when you're looking at Singapore, this is pricing off of LNG, just given the fact that they don't have their own natural gas. So you have to price it off of LNG. That is elevated. That's increasing the cost of hydrogen. And then when you look at just storage in general, that's seeing a bigger increase. So again, things have gotten better, and we're going to show both. This is just one of them. And then later on, we're going to show where they are right now. But when you look at China, so China crude imports, so China's September crude imports came in at 10.01 million barrels a day, month over month. That's a decline of 513,000 barrels a day versus, and then when you look at it year over year, that's a decline of 1.8 million barrels a day. So in September, we had a decline, and then in October, we don't see a decline. We just see it staying, fairly depressed. It'll be up from this low, but it was down 513,000 barrels a day from last month, and it's down 1.8 million barrels a day versus 2020. So just think about what they're looking. They're trying to work through some of their excess. Remember, they were about 120 million barrels over where they were pre-pandemic. They're still trying to pull that down, but in total, China Jan through September crude oil imports fell 6.8% year over year to 387 million tons. So just giving an idea of where we sit year to date, we're still well below where we were in 2020. And obviously 2020 was a tough year. And one of the things as we go through, some of these flows, we have the European imports of clean product from East Asia this month continuing to remain elevated. That will continue to come through. Again, that competition between which is why our distillate will remain lower than where it normally is, because that route has flipped. Typically, we go from the U.S. on the distillate side, PAD 3, into Europe. Now Europe is coming into pad 1. So those are some of those adjustments. But when we look at the future of exports, you can see that the WTI is still very expensive versus Dubai. It's not as expensive as it was. It was at a maximum of about $442 more expensive. It is now back to about $4.11, but you can still see where we are. And then the fact that West Africa continuing to struggle to clear, that just means that if you want crude, it's available. And are you going to go to the US for it, or are you going to go to West Africa, especially if you're Asia, just given the distance and how expensive diesel is? Because remember, these VLCCs and these clean product tankers, what do they move? They move product, and they move it by burning diesel at ultra low, high sulfur, depending if you have a scrubber, or some sort of marine gas oil. So again, that's where you're seeing some of those headwinds remain in the Asian market. And then the same can be said when you look at Brent versus Dubai. So when you look at what has happened so far, we had some discounts coming through where Glencore sold Fortes, delivered at dated plus 80 cents, which compares with where it was at plus 90 cents. So again, you're seeing these 10, 15 cent decline increments that continue to roll out, especially on the crude side. So then when you look at what is happening so far, again, before we get into the gasoline export side, you also had Iraq. They cut their OSPs. We've had Iran also cut OSPs, not surprising. So you're seeing some of this walk back on the physical side, obviously while futures continue to increase. So the disconnect continues to grow between where futures are telling us are going to be and where the physical market currently is, which is why when you look at OPEC and there's this call for increasing flow, well, it's like, they're looking at the physical market and they're saying, well, but I'm not making all that more on my physical volume. And then there's comments about OPEC, excess supply, and they're like, oh, well, OPEC is struggling to meet their quotas. And it's like, no, they're opting not to, especially when you look at West Africa, because West Africa has a very low quota, production rate right now, and they're still having trouble selling it. So it gives you an idea of some of the overhang, especially as you look at West Africa into Asia. Now, when we look at gasoline exports, as we were saying, we expected a bounce closer to the 5-year average. We expect it just to continue to kind of bump along, but below the 5-year average. It'll just move with it, but at a reduced rate. Still not going below it, the cloud, but again, just kind of bumping in the middle between the low end and that 5-year. And then distillate, bounced back into the 5-year cloud. We just expect it again just to kind of go sideways at this point, just given some of the overhangs and then just the shortages in our market. Why would you be exporting it? So then when we look at ethane exports had a big bounce over the last 2 weeks. You can see that they still remain elevated. When you look at feedstock cost versus naphtha, obviously condensate is priced at a premium. NGLs are priced at a premium. And I should say, I should clarify that the heavier side of the NGL barrel is priced at a premium. Ethane is still priced at a premium, but still the cheapest of them all. So that is going to keep those exports at a seasonally adjusted all-time high. Then when you look at oil exports, as we were saying, just going sideways, our expectation, 2.6 to 2.8 million, coming in on that average of 2.7 million barrels a day, 4-week rolling average at 2.614. Again, right kind of where we've been highlighting. And then when you look at LPG had a bounce, we expect it just to continue to be at that elevated level, even as pricing continues to go higher. So then when we look at ARA in crude, here you can see that we had a little bit of an increase. That is going to continue to go up. Again, still below that 7-year average, but still kind of continue to move up as Europe takes in a bit more crude and increases some of their run rates. Now, when we look at some of the shifts, so we had a decline in gas oil of 39 tons, and that is a lot of that is being driven by the Rhine. So the Rhine is now back to a level that can be transited with greater weight. So that is bringing additional cargoes that were a bit delayed. That's now moving it further inland. So this is something where on the gas oil side, we're just going to continue to bump along the bottom just because we're seeing a lot of demand. We're going to continue to see that demand in general, but supply will start to respond. So that's going to, again, keep us fairly stable. The comps get a little bit easier, but still at a seasonally adjusted, very low level of storage. Gasoline right at the 13-year average. We expect, as we were saying, exports will slow. This is going to turn this back up and it'll be just above that 13-year average, but again, still staying fairly tight along that line. Now, the fuel oil side, we're starting to see a big increase in exports of fuel oil leaving Europe for Asia as Asia continues to try to source fuel oil and other means of power and heating heading into the winter months. So you can see there's more than enough fuel oil. So, and just given, again, regulations, you can't burn fuel oil unless you have those scrubbers within Asia, within Europe, and there's still a high carbon tax. So is it cheaper to burn fuel oil or diesel? Is it cheaper to burn coal, or is it cheaper to burn natural gas? Even with some of these price increases, just given where we are on that carbon tax, that makes things a little bit difficult. But again, we're going to see fuel oil levels drop as we continue to see these movements in continuing to roll out. So when you look at the gas to oil switch underway in Asia and the Middle East, again, this is going to pull from here. So this is going to be something to watch to see how much that pull is pulling in and impacting that in general. So in 2016, European oil-fired power generation picked up significantly, but that has not been the case recently, whereas countries like Pakistan, Bangladesh, India, and Japan have greater flexibility. And this is what we were talking about. Europe has taken some of these offline, and not just offline where they just turned they locked the door and left. They tore them down, and that's where you're not going to get the same switching capacity. You'll still get switching. Don't get me wrong, as we talked about last week with the percentages. But a lot of this is going to go into those emerging markets, especially in Central and Southeast Asia. So then when we look at those loading schedules, you can there were some deferrals for Angola out of October into November. So and we're already starting to see that build back up, which is going to slip some of this October into November. They were expecting that, which is why Angola had a loading schedule that was a bit light. And they expect to see some of those additions. Nigeria has already seen that. That's kicked over. And then Russia is starting to see an increase because CPC volumes are increasing in October and November. So that's why you see that jump from August, September, and then into October. It'll go up again in November just because we're getting to the end of, and you're seeing more come through that CPC side. So again, Angola deferred the cargo of crude from late October into November loadings, and then loadings for Nemba in October revised to 92 with 3 cargoes. November exports revised higher. Vital withdrew an offer for Urals at $2 less dated Brent, because remember, you need the bid on the other side, and they're trying to test the waters. But so far, the last trade happened at $2.75 and $2.85 less dated Brent. So you're still seeing a lot of those headwinds. Iran cut crude OSPs for November. Delivery for light to medium at B-Wave minus $3.80 for November versus minus $3.25 for October. Senegal reduced its offer price to spot buyers for a cargo, and Nigeria again. So Angola's lowering prices. Now on the other side, when you look at loading schedules, so then Angola and Congo crude for November loadings are clearing at a much slower pace than October cargoes did around this time last month. Angola has yet to sell 7 to 8 cargoes out of 33. That's a slower pace than a month ago when 4 to 5 shipments were remaining. But remember, so last month it had 38 cargoes. This month it had 33 cargoes, and they still can't sell. So again, you're seeing cargoes come down, still struggling to sell. And the issue is there was hope that once we got back from Golden Week, you were going to start to see China pick up, but we're still waiting for the teapot refinery quotas, still not there, which is putting some of that pressure. And then the oddest side is the Republic of Congo is still searching for buyers on 3 to 4 cargoes for November out of 7 planned. And that's a slower pace than last month when 1 to 2 consignments were unsold as of September 10th. So that's where, again, all of that crude normally goes to China. So it just points to what is happening in Asia right now and some of this overhang. But you do have South Korea and Japan increasing some of those runs. So there's more than enough crude to meet those increases. And that's why it's so important to watch what is happening at the storage side when we're looking at the refined products. So October 11th, looking at Fujairah, so we had a really big build in light distillate, a big draw in middle distillate, and a smaller draw in heavy. But you're still seeing some of these shifts. So right now, as reported, there was a draw of 1.029 million barrels. And that's a reversal of last week's build. The total stock draw was driven by decreasing stocks in middle distillate and heavy resid. So on the light distillate side, gasoline and naphtha rose 1.311 million barrels on the week, which is now up to over 6 million. Asian gasoline supply was increasing after South Korean oil refiners raised their crude run rates to the highest level in a year and a half since COVID outbreak to meet a stronger oil product demand side and higher refinery margins, which again is on the middle distillate side. So you're going to continue to see that's going to be where, if we start to see those storage numbers go up, it means that not all of it is getting taken down, and we could see some of these adjustments. But the country's top refiner, SK, which has kept its crude run rates under 70% since last year, has recently raised its run rates to mid 70%. SK Innovation is ready to further raise its crude throughput if market conditions remain favorable. Local refiners are pushing to further increase their crude throughput later this year as refinery margins remain strong. Stocks of middle distillate, diesel, and jet fell by 1.267 million barrels. They had a big draw. That's a reversal of last week's rise. Market participants said they expect demand for jet to remain supported by favorable arbitrage economics and limited supply from Northeast Asia. Further support is expected as Japan has started seasonal stockpiling of kerosene ahead of winter. And then as countries veer away from COVID zero policies, demand for travel should further improve. So you're starting to see some of those movements. Middle distillate is weak. That's the one to watch because right now that's a fairly bullish backdrop, especially when you're looking at that distillate crack. So that's going to be an important one going forward. Heavy resid fell by 1.093 million barrels. This is a reversal of last week's build of 1.452. Despite average spot trading in Fujairah, more bunker stems were seen due to the cooling flat price, though buyers were still cautious about meeting bunker requirements amid a strong flat. During and outside the MLC, offers for delivered marine gas oil were heard about 600. So the lower end of the price range was for products delivered from October 4th onward. The availability of low sulfur fuel oil bunkers is slightly tight, but would only be short term due to inconsistent demand. So again, there's also going to be heating demand and electricity demand coming from heavy and resid. So you want to look at those as two buckets. Those two buckets as one right now, and that's where you're starting to see some of these draws. But again, middle distillate, we'll get a little bit of a build next week. Some of these offsetting sides, but you want to see if the trend, is storage making a lower high, storage draws making a lower low. That's going to be indicative of again that tightening market on the middle distillate side, which will be supportive of cracks and increase these runs in Asia. So now on the Singapore side, we had a bounce of about 600,000 barrels. It was really driven by residual, and residual is the only one that really saw that increase. So when you look at that bounce, we're still above the 15-year average. And as we were saying, we expect to be just at that 15-year, either just below, just above, as we get some of that competition between Here you can see that bounce, as we were saying, on the residual side. We expect this to stay fairly up, still above the 15-year average, but that switching is going to be important to watch what is happening in resid and what is happening in middle distillate. So then on the light distillate side, you can see that we had a nice drop and then we're going sideways. We expect this just to continue to go sideways as the focus remains on with middle distillate, which is now below that 15-year average. But as we were saying, with that new increase in runs from South Korea, from India, you're starting to see some of that pivot now. Because remember, India was cutting runs. Now they're increasing runs after saying they were going to cut them. So that is going to kind of flatline some of the storage. Still be in a bullish position, but it will be met with some additional supply. And this is where, when you look at crude oil on the water, we're starting to see these steady increases. This will continue to move up along that 5-year average. And crude oil in transit is continuing to start to creep back up. You can see that it's, again, very lumpy. There's still this shift in, and we're seeing, instead of less crude oil, because when you look, crude oil on the water is increasing, but in transit is only slightly increasing because we had a big increase in floating storage. So you can see we're back to the highs that we haven't seen since May. You're starting to get back. We had these flat points before in the end of July and in the end of August. We actually expect this to continue to drift higher just because we're seeing some of these storage levels continue to be elevated in Asia and West Africa as the two biggest drivers. So then when you look at the Brent time spread, we're hovering right around that 68 cents when you look at just December versus January. So still kind of, we had that big spike, then we had that big drop. Now we're just, essentially going sideways. As the December versus December, this December is pricing very strong versus next December. So again, if you're in an interesting position on what you view next year at, this could be an interesting spread for those that are looking to put on a little bit longer dated. So before, at the very beginning, we showed that one specific slide. Now we're looking at something a little bit differently, of just straight price. So when you look at that, a lot of that price increases, you can see that there still is margin there. It's just a matter of what are you running, where Dubai versus Arab Light. And so when you look at some of the shifts, there's still that demand, which is why we expect, even with some of the adjustments on cost, you're going to see some of that pricing get pushed through, which again will be supportive and keep some of these runs elevated. Then when you look at where we are on the Dubai hydrocracking side, you can see that spike, is coming down just a bit, but still elevated, providing some of that support. Urals continue to price at a steeper and steeper discount, which again is providing some of this support within Northwest Europe as well, and that will put a little bit more gas oil, again, meeting some of that additional supply. And then when you look at the Mediterranean side, you can see that there's a lot of competition with Libya, Urals, Libya, crude, Urals, CPC, and Iraq coming through Kirkuk or Cyan. So again, you're going to see this remain fairly strong, just given the price increase, the price decreases, trying to offset some of those costs. And then when you look at China, supertanker crude imports very much along seasonal norms. But the Asian floating storage, you're seeing it come back just a bit, but still remaining at these elevated levels. There is a typhoon moving through, specifically Hong Kong. So we could see a little bit more of a dip as, again, boats move out of the way. But you can see we're just at this elevated stuck spot, and then more crude is expected to continue to get there. North Sea crude had a drop. Some of this stuff is getting priced a bit more to move. We're seeing additional imports from offshore onto onshore, which again is driving some of that through. And then West Africa has storage at a new 2021 record, which again speaks to they have cut runs, they've cut production, they've cut quotas, and they still have this elevated amount of crude sitting in floating storage, which, again, this is more concerning for Asia. And this is going to be one to watch of how much distillate is being created in Asia. We should start to see some of these barrels move. Then when you look at the Middle East, this was another important one I said to watch. We thought it was going to turn back up. Instead, it had a nice drop. So we want to look, we saw prices get cut, OSPs get cut, again, trying to move some of these cargoes. So I think they may have been seeing something what we were seeing. So they issued those cuts. They've lowered prices, not only just for November, but also for October, accelerating some of these through in general, and again, pulling some of this out of storage. Then when we look at Europe has fallen back to a low, but as we were saying, we expect this to be a bit of a chevron pattern, if you will, going forward, just below the 5-year average, just above that low end of the cloud, continuing to move through. I don't have the China data for you today, but I will hope to have it next week. So that's all we have. If you have any questions, we always love the feedback. If you have any comments, questions, you can reach us in the comment section. Find me at MarkFNY on Twitter. Always happy to have a back and forth. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primer Vision Network.